When it comes to protecting your family's financial future, not all life insurance is created equal. Hey everyone, I'm Gregory Rozdiba here from Dundas Life. Today we're settling an age-old debate: whole life insurance versus universal life insurance. Which one comes out on top? We'll break down the pros and the cons, the hidden details, and help you determine which policy aligns best with your family's needs and your financial goals. By the end of this video, you'll be a life insurance pro, ready to make confident decisions. But before that, don't forget to like this video and subscribe to our channel. So let's dive in. Let's start by breaking down whole life insurance. Think of it as a set it and forget it option. Reliable, predictable, and built to last. Here's where it stands out. Whole life insurance provides lifelong coverage. As long as you keep up with your premium payments, your policy remains in force. No matter what happens in the world around you, markets may fluctuate, interest rates may rise or fall, but your coverage stays steady. This kind of predictability can be a huge relief, especially as you get older and want to ensure that your family is protected. Another key feature of whole life insurance is its fixed premiums. Once you set your premiums, it never changes. You'll pay the same amount every month or year, no matter how long you live. This level of predictability makes it easier to budget and plan for the long term, knowing there won't be any unexpected increases down the road. But that's not all. Whole life insurance also comes with something called cash value. A portion of every premium you pay goes into the cash value account, which grows over time at a guaranteed rate. Imagine having a savings account that steadily grows no matter what happens. The beauty of this cash value is that it's not just sitting there, it's working for you. Need cash for an emergency or an investment opportunity? You can borrow against your cash value without a credit check. Now, some people might say whole life is expensive or inflexible. While it's true that premiums are generally higher than term life insurance, you're paying for the guarantees and peace of mind that come with it. And while it's not as flexible as universal life, whole life offers unparalleled stability and predictability, which is invaluable for many families. Now, let's explore universal life insurance. This option is all about customization and control, allowing you to adjust your policy to fit your changing needs. First, let's talk about universal life premiums. Unlike whole life, where your premium is fixed, universal life gives you the ability to adjust your premium payments. This can be a huge advantage, especially if your financial situation changes over time. For instance, if you're doing well financially, you can pay more into the policy to increase the cash value or even pay off the policy faster. On the other hand, if money's tight, you can reduce your premiums for a while, as long as there is enough cash in the policy to cover the cost. But the flexibility doesn't stop there. Universal life also allows you to adjust the death benefit. So if your financial needs change, say you pay off your mortgage or your kids are grown and independent, you can decrease the death benefit and lower your premiums. Or if you come into some extra cash and want to leave more for your beneficiaries, you can increase the death benefit. This ability to tweak the policy over time is a big draw for people who anticipate changes in their financial responsibilities. Another major feature of universal life is the potential for higher cash value growth. Unlike whole life, where the cash value grows at a guaranteed rate, universal life ties the growth of your cash value to investment performance. You can choose to invest in fixed accounts, which offer lower but safer returns, or opt for indexed accounts tied to market indices, which could offer higher returns but come with more risk. It's a bit like having a portfolio within your life insurance policy. You can diversify, take on more risk for potentially higher rewards, or play it safe. However, with greater flexibility comes greater responsibility. If the investments underperform, your cash value might not grow as much as you'd like, and you could end up needing to pay higher premiums just to keep the policy in force. So universal life is often better suited for those who are comfortable with taking on some level of investment risk and who like having more control over their financial future. Alright, now that we've covered the basics for both types of insurance, let's get to a critical factor for many: cost. Whole life typically comes with a higher price tag up front. You're paying for guarantees and simplicity. It's like buying a luxury car with an all-inclusive warranty. Universal life can be more affordable initially, but costs can fluctuate based on investment performance and insurance changes. It's like leasing a car with the option to upgrade or downgrade as you go. So if someone who likes to know exactly what you're getting into and can afford to pay a bit more, whole life options may be the better option. But if you prefer flexibility and are willing to take on some investment risk, Universal Life could offer more value over time. Now let's take a closer look at one of the most significant aspects of these policies, the cash value. This is where whole life and universal life really start to differentiate themselves. With whole life insurance, the cash value is like a savings account with a fixed interest rate. It grows steadily and predictably over time, and you can count on that growth no matter what's happening in the financial markets. This predictability is a big selling point for whole life. You can borrow against the cash value, use it to pay premiums, or even surrender the policy. And take the cash if you decide that you no longer need the insurance. It's like having a rainy day fund that's always there, growing at a steady pace. Universal life insurance, on the other hand, offers more potential, but also more risk. The cash value in a universal life policy is tied to the performance of investments, which means it can grow faster if those investments do well, but there's also the chance that the growth could be slower, or even stagnate, if the investments underperform. Think of it as a stock portfolio. You have the potential for higher returns, but you also need to be prepared for the ups and the downs. This flexibility can be great if you're savvy with investments and like having control over where your money goes. But it's not for everyone. If you're someone who prefers certainty and doesn't want to worry about market fluctuations, whole life's guaranteed growth might be more appealing. With that said, some people love the idea of using their life insurance policy as an investment tool. With Universal Life, you can choose where to allocate your cash value, whether in more conservative fixed accounts or riskier index accounts tied to market performance. So who's the winner? Well, that depends on you. Choose whole life if you like value predictability and guarantees. You want a set it and forget it approach, you're looking for stable, guaranteed growth. Go with Universal Life if you want flexibility in premiums and coverage. You're comfortable with some investment risk, and you like having control over your policy's performance. If you're someone who values stability and wants a straightforward, predictable policy, whole life insurance might be the way to go. It's especially appealing if you're looking for something that you can set up and then not have to think about too much. You get the peace of mind that comes with guaranteed growth and fixed premiums, which can be incredibly comforting as you plan for the future. On the other hand, if you're someone who likes to have control and is comfortable with taking a bit more risk for the potential of higher rewards, universal life insurance could be a better fit. It's ideal for people who anticipate changes in their financial responsibilities over time and want the flexibility to adjust their policy. Plus, if you're savvy with investments, the ability to influence your policy's cash value growth can be very appealing. Another crucial factor to consider is your life stage. Your insurance needs will likely change as you move through different phases of life. Young adults, if you're just starting out, the flexibility of universal life might be appealing as you navigate career changes and growing financial responsibilities. Growing families. As you start a family, the guaranteed coverage of whole life can provide peace of mind, ensuring your loved ones are protected, no matter what. Pre-retirement. At this stage, investment components of universal life might be attractive as you look to maximize your retirement savings. Retirement. In retirement, the cash value of either policy type can be a valuable asset, providing additional financial security or helping with estate planning. Remember, the best policy is the one that fits your situation. At Dundas Life, we're here to help you navigate these choices and find the perfect fit for you and your family. Ready to secure your family's future? Click the link in the description to book a free consultation with us. We'll walk you through your options and help you make the best choice for your needs. If this video helped you understand life insurance better, give it a thumbs up and share it with someone who could benefit. Don't forget to subscribe for more financial insights that could change your life. Until next time, take care and stay informed.